All right, it is 11 o'clock, and as people come in, they will be joining. I am Darius Young, and I am the Director of Organizing here at BARHII for Black Health. And this is a part of a series that we will be doing for capacity building events for our members and people that are interested in the Black Housing Advisory Task Force, effectively known as Black Hat. Our task force, the Black Housing Advisory Task Force, um, is a group of, we are experts in Black housing. We're advocates, we're CBOs and organization and allies that help service our Black communities. We see a great connection, a real need for health and housing are intertwined. And so our job in doing our Black Hat coalition and people that are involved is to promote Black housing and to be able to do that from home ownership to rentals to even to reentry housing, special housing needs, anything that furthers the housing of African Americans in California and to help to promote health. This morning, we have a very, very special what um, webinar, and that's going to be led by Natasha Dowdy of HFA, excuse me, I get that, it's a tongue twister for me. And she will be presenting on two programs that are, one is very time sensitive. One is the Dream for All, and then the other is directly related to home ownership opportunities. And so you all will be on mute throughout the entirety of the webinar. And when the webinar has ended, we will ask you to put your questions into the chat, and I will be reading those questions off. So if you have any questions, jot them down as the presenter is presenting. And then once she has presented on both programs, I will be taking the questions and giving them to her. So that's where we're at today. Sit back and take in the information and pass it along to each other. This webinar will be recorded. And so for those who you know that were unable to make it, they can receive a recording of the webinar. Thank you. And I'll turn it over to Ms. Natasha Dowdy so that she can introduce herself and get this thing going.
Thank you, Darius. I
You're welcome.
appreciate the warm welcome. Thank you so much. So glad to be here presenting to you today. My name is Natasha Dowdy, and I'm with the California Housing Finance Agency. We're also known as CalHFA. Before I get started, I want you to focus in on the information displayed on the screen right in front of you. Please jot down our website. Our website address is calhfa.ca.gov. There's lots of information on our website, lots of videos, helpful resources to help you understand the programs that we have available. You will need that web address to find a CalHFA approved loan officer, in addition to just reviewing all the information available on our website. So please make sure you have that web address handy. Also, if you ever have questions, you can email our lender training at calhfa.ca.gov. We have a team there monitoring emails. If you have questions about our programs, definitely send us an email, and one of my teammates will respond to your email. But let's get started. So, who is CalHFA? CalHFA, we were founded in 1975 with the goal and mission to provide special financing and down payment assistance to help low to moderate income home buyers achieve home ownership. As you all know, living in California is very costly. Uh, you have high gas prices, high utility bills. Everything is so unaffordable at the moment. And then, in addition to that, the purchase prices and interest rates are at an all-time high at this time. So with the daily expenses that everyone has to pay just to live, it's making it difficult for individuals to save money to set aside to help cover their down payment. And that's where CalHFA comes into play. We are here to help individuals meet their down payment and or closing costs with our special financing programs that we have available. Just to give you some information, CalHFA, we are a state agency. However, we are a self-funded state agency. So we have our standard programs that we offer, such as our My Home Assistance Program and our Cal Plus ZIP program that are our standard programs, and we never run out of funds on those programs. However, there are times when we offer specialty programs, such as the Dream for All Shared Appreciation Loan Program or the California ADU Grant Program, which is no longer available. Those particular programs are specialty programs where we act as the administrator for those programs, and we get funding from the state to offer those programs. But to start out, the first program that I'm going to talk about is our My Home Assistance Program. And then I'm going to cover our Dream for All Shared Appreciation Loan Program. And I want to give you that information so that you know that there's options out there. As I mentioned, the Dream for All is a specialty program, and we have limited funding on that program. But I want to make sure that you have the knowledge and the education regarding the programs that are always available at CalHFA. Again, our mission at CalHFA is to invest in diverse communities with financing programs to help more Californians have a place to call home. That's our goal. We want to increase home ownership throughout the state of California, and I'm here to help educate you on the programs that are available. So let's get started. So one of the most popular programs at CalHFA is our My Home Assistance Program, and it's a down payment assistance program. As you know, when you're looking to obtain a loan to purchase a home, the lenders have a down payment requirement that you have to meet. And it can be very expensive to help cover that down payment requirement. And My Home Assistance is there to help individuals meet their down payment requirement. So our My Home Assistance program can allow an individual to borrow up to 3% or 3.5% to cover the down payment and or closing costs. It just depends on how the loan is structured. And I think My Home Assistance Program is a fascinating program because it could be combined with a conventional first mortgage, an FHA first mortgage, even a VA or a USDA first mortgage. My Home can work interchangeably. It could be used as a down payment or closing costs. And basically, to calculate how much of a loan you can receive under the My Home Assistance Program, you would take 3% of the purchase price or appraised value, whichever's less, to compute your loan amount under the My Home Assistance Program. Now, our My Home Assistance loan, it is a loan. It's not a grant, and it's not forgivable. It is a silent loan on the property. So say for instance, if you're looking for financing on a conventional loan program for the first mortgage, my home could go up to 3% of the purchase price or appraised value, whichever's less. And that's if you're using the conventional VA or USDA, we would allow up to 3% of the purchase price or appraised value. If you are looking to have a FHA first mortgage, my home could go up to 3.5% of the purchase price or appraised value, whichever's less. Now, I mentioned my home assistance is a loan. It's not a grant and it's not forgivable. It is a loan and it has a 1% simple interest rate. So let's say you borrow $20,000 to help cover your down payment and or closing costs. How that 1% interest would accrue with the original balance is on a $20,000 loan amount, $200 would be added to the original loan balance in year one, in year two, in year three, and so on and so on. So my home, it acts as a silent second. So what that basically means is you don't have to make a payment while you're in that program. The payments are deferred. The loan will become due and payable should you refinance on your first mortgage, decide to sell your property, or at the end of the 30-year term. My home would become due and payable should any one of those events occur. But tell me, where could you possibly get a down payment or closing cost assistance program at a 1% simple interest rate? I can't think of any program out there that will allow you to, borrow money to help cover your down payment or closing costs. So our My Home program is our My Home Assistance Loan program is designed to help individuals obtain home ownership by covering their down payment requirement. And I think it's a really good program. As I mentioned, the funds on our My Home Assistance program is always available. We don't run out of funding for our My Home Assistance program. So it's a great program out there to help assist those who need the help with purchase, with coming in with their down payment to help obtain home ownership. So with any loan program, there's requirements. Anytime you're looking to borrow money from a lender or you're seeking out a loan, there's always going to be requirements. And we have a few requirements that we must make sure that the client or the home buyer meets. And that first requirement is there's a minimum credit score requirement. So if you're utilizing a government first mortgage, that's FHA, VA, or USDA, there's a minimum credit score requirement of 640. So we just want to make sure that those individuals have a good credit profile when they're utilizing our assistance. Now, for anyone that's utilizing a conventional first mortgage, we require them to have at least a 680 credit score. Now, we will go down to a 660 credit score for those individuals who are considered low income. And how would you determine whether or not someone's considered low income? You would talk to a CalHFA approved loan officer, and they'll determine if the client is at 80% AMI or below, and that would identify them as a low income home buyer. So again, on a conventional first mortgage, your minimum credit score would have to be at least 680. But if you are considered low income, we will allow that minimum credit score to go down to the 660 minimum. Now, we do also have a max debt to income requirement. And essentially, what that means is we want to make sure that the client isn't overextended with their monthly obligations on their credit report based in comparison to their gross monthly income. So we have a max debt to income of 45.00%. For anyone with a credit score below 700. Now, if their credit score is above it's 700 or above, we will allow the debt to income to go to a 50% debt to income. And so I think this is very, very, very important. You want to make sure your client, you want to make sure if you are looking to purchase a home, or if you know someone else that's looking to purchase a home, that they know that during that process or even before that process, not to go financing an auto or a boat to, to minimize their credit obligations that they're extending when they're purchasing a home. Because if they're over that amount of the 45% debt to income, or 50 if their credit score is 700 or above, that can affect how much house they can purchase. So you definitely want to make sure your monthly obligations on your credit report are low or in line. And it's always best to be transparent with your loan officer that you are working with when purchasing a home, to make sure that your monthly income and the monthly debts on your credit report are in line. With our down payment assistance programs, we do ask that you meet our definition of a first-time home buyer. And I think our definition of a first-time home buyer is it's doable. It's doable. Our definition of a first-time home buyer is that the applicant does not have any ownership interest in their primary residence within the last 3 years. So I'm going to repeat that. Our first-time home buyer definition is no ownership interest in your primary residence within the last 3 years. So let's break that down a little bit. So to meet our definition, we're just looking to see if the client has owned a home within the last 3 years. And if they have, did they occupy that home as their primary residence? If that's a no, then they meet the definition of a first-time home buyer. You can have an individual currently owns an investment property. And if they currently own an investment property, as long as they can document that they haven't resided in that investment property within the last 3 years, they meet the definition of a first-time home buyer. So it's not first time forever. I know it can look that way, but it's not first time home buyer forever. And I think this is a great tool. There will be additional documentation needed if you have, or you know a family or a friend that's owned a property or currently owns an investment property. Additional documentation will be needed, such as a verification of rent for 3 years, or 3 years council rent checks, or 3 years utility bills proving that they have not resided in that property that they currently own. We're just looking to see where they have been residing or paying rent to ensure that they meet the first-time home buyer definition per CalHFA. In addition to the first-time home buyer requirement, we also want to see that the applicant complete a home buyer education course. And this is simply just to make sure that the client is fully educated on the process of purchasing a home. We want to make sure that they fully understand what it takes to purchase a home and what it takes to successfully maintain home ownership after the loan closes. The course is an 8-hour course that we require, and they're learning so much knowledge with a homebuyer education course because we care at CalHFA. We want to make sure that once you obtain the assistance and the loan closes, you know how to keep your home and how to maintain home ownership. Once you complete the homebuyer education course, you will be issued a certificate. The certificate is good for 1 year. And only one borrower on the loan must complete the certificate. But we just want to make sure that all the applicants, they're successful, they're educated, and they know what it takes to be a homeowner. Because, you know, purchasing a home is a huge financial decision that one may make. In addition to the homebuyer education course, we also have income limits. And I feel that our income limits are very moderate. You'd be surprised. So on our My Home Assistance program, if someone is looking to purchase a home in Alameda County or Contra Costa County, as long as their income is at or below $292,000, they're within our income limits. And we're only looking at the income of all individuals that are on the loan. So we don't go off a household income. We're strictly just looking at the income of all borrowers on the loan. If you or a family member is looking to purchase in Sacramento County, Placer County, Yolo County, as long as your income is at or below $225,000, you're within the income limits. If you're looking to purchase in San Francisco, San Mateo, or Santa Clara County, as long as your income is at or below $300,000, you're within the income limit. And some may even be looking to purchase in San Joaquin County. If your income is at or below $198,000, you're within the income limit. And I think this is a very moderate level for individuals looking to purchase a home. And keep in mind, our income limits are based on the county in which the borrower is looking to purchase in. And it's not household income. It's just we're taking the income of all borrowers on the loan. And I think that's doable. I think these limits are doable and attainable and reachable. So I talked about our My Home Assistance program. I told you how to calculate the loan amount, what it could go up to. I told you what the requirements are of the program. Now let's put this all together. And here is an example. So if you or a family member or you know someone that's looking to purchase a home, on this example is showing you a CalHFA FHA first mortgage with My Home Assistance being used to help cover the down payment. So in this scenario, we have the purchase price listed at $500,000. So on an FHA program, on an FHA loan, the base loan amount on this program is at $482,500. So that's just the base loan amount. So My Home is being used in conjunction with this FHA first mortgage. And remember, I stated that My Home Assistance can go up to 3.5% of the purchase price or appraised value, whichever's less. So My Home Assistance is calculated out to $17,500. Essentially, that's meeting the full FHA down payment requirement. That $17,500 is covering the full down payment requirement. So with this scenario, I estimated the closing cost is 3% of the purchase price. And that came out to $15,000. And hopefully the realtor can advocate for the home buyer and they can ask the seller to give a seller credit. So in this scenario, the seller was able to give a seller credit, or we could call that a seller concession of 2.5%. So that's 2.5%, that seller credit is computing out to $12,500. When your seller is issuing you a seller credit, that can be used to help cover some of that closing costs. And as you can see above, the closing cost in this scenario is $15,000. So in this scenario, in total, the borrower is estimated to come in with $2,500 on purchasing a home under a CalHFA FHA first mortgage with my home as a lien and second lien position. That's doable. That's helpful. That's extremely helpful. I think it's a great tool to help individuals get into that home. That way that they don't have to come in with that down payment, because my home is there as a silent second on the property and helping cover that full down payment requirement. Now, on our My Home Assistance program, a client, if they do have some money saved, like if they have saving money saved in their 401k, I don't recommend it, but if they have money saved in a savings account or a checking, or if they opted to get gift funds from a family member, they can combine those funds along with the My Home Assistance program to further give a larger down payment to help them lower their monthly obligation on their first mortgage. We don't put a cap to the amount of funds our borrower wants to contribute towards the down payment. So it just depends on how the loan is structured and how the client, because every home buyer has a different scenario, and that's why it's important for that home buyer to work with a CalHFA approved lender so that they can go over the different options on structuring a loan. But this is a great example of how the My Home Assistance loan program can help the individual obtain home ownership. So now, as I talked about the borrower requirements, and I gave you a quick example of how the My Home Assistance can help cover the down payment requirement. Let's discuss the property requirements under our programs. So on our programs, we have very few property requirements. We ask that if you are looking to receive down payment assistance, we ask that you purchase at least a single family residence, 1 unit, or it could be a condo, or it could be a townhome or a townhouse. It just has to be identified as a 1 unit property. But we will allow that single family residence to have an accessory dwelling unit. So that accessory dwelling unit cannot be identified as having its own separate address. It has to, when the appraiser goes out to appraise the property, it has to be identified as a single family residence if the single family residents have a accessory dwelling unit. And sometimes those accessory dwelling units are called an ADU unit or granny flat or a pool house or a mother-in-law unit, as long as it's identified as having a 1 unit property, we will lend on that property. And I think that's a great tool to help offset your mortgage payment if you do find a property that has an accessory dwelling unit, because you could rent it out, and that's acceptable. We just ask that when you are utilizing our down payment assistance, that all borrowers on the loan occupy the home as their primary residence. So we won't allow a non-occupying co-borrower or a co-signer with our down payment assistance program. So all borrowers on the loan must intend to occupy the property as their primary residence. Now, we will also allow manufactured homes. And I must tell you that manufactured homes, you might want to explore it, especially in this high-priced market that we're in. purchase prices are constantly on a rise. And if you look at a manufactured home, they have a resemblance of a stick built home. And when I say stick built, I mean a single family residence. So if you're in the market, or if you know someone that's in the market of purchasing a home and prices are just too high, consider looking at a manufactured home. Now, with our manufactured homes, we ask that the manufactured home be on a permanent foundation. It can't be a mobile home. It can't be on a movable mobile home. It has to be on a permanent foundation. And it also has to be double wide. We will not lend on a single wide property. So if that's a little confusing, please talk to a CalHFA approved lender. They'll further unpack the requirements of the manufactured home, but we will lend on it. And you'd be surprised. The manufactured homes are priced a little lower than what a regular single family residence will be. But that's a great opportunity for you to get your foot in the door and to obtain home ownership. In addition to the property requirements that I mentioned above, we also ask that the home buyer obtain a 1-year home warranty. And this is, again, just to make sure that you are a successful homeowner. That 1-year home warranty, we're asking that it's a basic 1-year home warranty that covers the HVAC, stove and oven, and water heater. And really, again, that's CalHFA looking out for the home buyer. We want to make sure the home buyer is successful we will in its entirety, but that first year is crucial, and we want to make sure that the home buyer is a successful homeowner. Just think, if you purchase a home, it's a lot of expenses when you're purchasing a home. But if you're purchasing a home that first year, you may be used to contacting your landlord to if something breaks or you need some repairs. But when you're a homeowner, that's all on the homeowner. So if your HVAC goes out and you're in an area like San Joaquin or Sacramento where it's crucial that you need an HVAC unit, if that HVAC unit goes out and you don't have a 1-year home warranty on your home, you're looking at $30,000 just to replace that HVAC. Whereas if you have a 1-year home warranty on it, it could cover the expenses, and you could simply come out of the pocket anywhere from $1,000. It just depends on the type of 1-year home warranty you set up, but the out-of-pocket expenses is very minimal versus not having that 1-year home warranty. And we're just looking to make sure that the individual is a successful homeowner with our programs. Now, if you're looking to purchase a new construction home, we waive the 1-year home warranty. We waive it because on new construction homes, the builder has its own 1-year home warranty in place. But this is a saver for the client. Now, we don't care who pays for the 1-year home warranty. It could be paid by the seller. It could be paid by the lender. It could be paid by the home buyer. We just want to make sure that a 1-year home warranty is in place and the client is protected. And when I say client, I mean the home buyer is protected from any, expenses that may arise. But in a nutshell, that's our My Home Assistance program. Those are our requirements. But I know everyone has been getting lots of talk and emails, or they've heard, they've seen information on social media about the Dream for All Shared Appreciation Loan Program. I tell you, I'm excited. I'm excited to talk about the Dream for All Shared Appreciation Loan Program. I'm not sure if you're aware, but we we launched this program last year. It was the first phase of the program, and the funds were all allocated out in roughly 8 business days. We had a holiday. That came in when the program launched, and there's talk of it's anywhere between 8 and 11 business days. I say 8, but the program was launched last year in March, and there was so much interest in this program because it allowed for a larger down payment. It allowed for a larger down payment, which in turn, when you have a larger down payment, it minimizes your monthly expenses. And as I spoke and told you, prices are so high right now. Purchase prices are high, interest rates are high. And so having that larger down payment helps individuals obtain home ownership, affordable home ownership. So I'm excited to speak about the Dream for All Shared Appreciation Loan Program because my team at CalHFA has been working diligently at strategizing and implementing changes to the second phase of the program to make sure that the funds get in the hands of those individuals that truly need the larger down payment. But I want to make sure you focus in on that full name of the program. I want to make sure you fully understand what this program is and how the program works. A lot of people will call and say, "Oh, give me information about that dream program." Or they'll call it the Dream for All. But I want you to focus in on the title of the program. It's a Dream for All Shared Appreciation Loan Program. Somehow that shared appreciation component gets left out of the name because it's lengthy. I get it. It's lengthy, but you have to make sure you fully understand that shared appreciation component. And I'm going to further unpack that in the presentation and show you an example of how it works. But to get started, the state allotted for $200 million to be allocated to this program. Last year, we had some fallout, so we had roughly $50 million of fallout from the first phase of the program. So this year, in total, we have about $250 million set aside to help individuals obtain home ownership under the Dream for All Shared Appreciation program. So Senate Bill 143 establishes parameters for the second phase of the program. They want to make sure we're targeting first-generation home buyers. And they also want to make sure that we have an equitable distribution of funding for this program. So we're making sure that all regions throughout California have an equitable amount of funding for this program. And I'll further unpack that a little later, but just wanted to give you a summary of what the second phase of the Dream for All program is targeting. So there has been lots of changes to the program. And that first change is that the loan amount on the Dream for All Shared Appreciation Loan Program is capped at $150,000 or 20% of the purchase price or appraised value, whichever's less. Now, this $150,000 or 20% loan amount, it can be used to cover down payment and or closing costs. So just think that on this program, it can only be combined with a conventional first mortgage. So since it's combined with a conventional first mortgage, that the Dream for All Shared Appreciation Loan acts as a silent loan on title. So there will be 2 liens on title with this program. You'll have your first conventional first mortgage with the Dream for All in second lien position. Now, since it's a conventional first mortgage, the credit score requirement is going to be 680 for anyone that's over the 80% AMI income limit. And I'll go over the income limits for this program, but I just kind of wanted to paint the picture of how this program can be stacked with the first mortgage. So you can't combine it with an FHA first mortgage or a VA or a USDA. That first mortgage on the Dream for All program must be a conventional Fannie Mae first. Now, with this program, you can use that $150,000 or 20% to cover the down payment and or closing costs. It just depends on how the loan is structured. In addition to the cap to the loan amount that we've made on this program, we also require that the applicants register on the Dream for All pre-registration portal. The first phase of the program, it was on a first come, first serve basis. And this time we've added, it's not a first come, first serve basis. It will be a random selection on who is selected to receive this program. So that's very, very, very key. Also, the pre-registration portal opens April 3rd, which is tomorrow, April 3rd at 8 a.m. And the portal will close April 29th at 5 p.m. Now, I'm telling you this, that doesn't mean that you have to go and register for the portal on day one. You could give it some time, but don't wait to the last minute. And I'll give you some information on how to prepare for the pre-registration portal. But just to keep in mind, you have to register for the portal. And I'll go over the steps that anyone that's interested on signing up for this program that they must take. And I'll tell you about that a little later. We did add a minimum combined loan to value requirement. And essentially what that means is you may have those individuals that want to get the $150,000 or 20%, whichever's less. And they may want to combine some of their own funds to give a larger down payment. And we'll allow you to do that, but we put a cap on the amount of borrower own funds that they can contribute toward to the down payment at 5%. So if someone wants to add in their own funds to give a larger down payment, it's 5% of the purchase price or appraised value, whichever's less, that they're allowed to do so. We have a minimum, we have a max combined loan to value at 105% CLTV. And essentially what that means is you may have someone that knows of another program that they may want to combine with the Dream for All program to help with some of the closing costs. And we will allow that up to 105% combined loan to value. It's just that they'll have to ensure that it meets Fannie Mae Community Seconds requirements. But if you're wondering of a specific program that could be combined with this program, I highly encourage you to talk to a CalHFA approved lender, and they'll be able to let you know if that outside program can be combined with our Dream for All shared appreciation loan program. The only catch is you can't combine our My Home program that I talked about earlier or our Cal Plus Zip program with the Dream for All shared appreciation. You cannot combine our standard programs with the Dream for All shared appreciation, but it is possible. Outside programs can be combined with our Dream for All shared appreciation program. Now, we do have income limits on the Dream for All program, and they're a little different than the My Home Assistance program. As you can see here, if you know you are someone or you know someone that's looking to purchase in Alameda County, Contra Costa County, the income limit is $234,000. So if you have an individual that earns at or below $234,000, they're within the income limit if they're purchasing in Alameda or Contra Costa County. Now, if you know someone that's looking to purchase in Sacramento, Placer, Yolo County, as long as their income is at or below $180,000, they're within the income limit. For San Francisco, San Mateo, as long as their income is at or below $277,000, they're within the income limit. Now, remember, the income limits are based on the county in which the borrower is looking to purchase in. And we're taking the income of all borrowers on the loan to determine if they're within the income limit. Santa Clara County, if they're looking to purchase in Santa Clara County, as long as their income is at or below $287,000, they're within the income limit. San Joaquin County, as long as their income is at or below $158,000, they're within the income limits. Now, if you know someone or you're someone that is looking to purchase in another county that's not displayed on the screen, go to our website. We have a chart of all the counties throughout California, and you want to specifically pull up the income limit for the Dream for All Shared Appreciation Loan Program. But lots of resources on our website. Lots of resources on our website. Now, as I mentioned, there's some changes on this second phase of the Dream for All, and here are a couple of the changes that people tend to have a lot of questions on. But keep in mind that the requirements that I'm stating here on this slide, it's only one applicant on the loan transaction must meet these requirements. So we're looking to see at least one applicant currently resides in California. I think that's doable. That's pretty easy. In addition, we're also looking to see at least one applicant is identified as a first-generation home buyer. And our definition of a first-generation home buyer is listed here. And if you have questions about this, please type your questions out. I'd love to take some scenarios if you have any questions relating to the first-generation home buyer requirement. But our definition of a first-generation home buyer requirement is the borrower cannot be on title or on a mortgage in the United States within the last 7 years. And their parents cannot currently own a home in the United States. So you can have a situation where your parent owned a home a year ago and they sold that home. As long as they don't currently own a home and the borrower hasn't owned a home within the last 7 years or been named on a mortgage in the last 7 years, they would qualify as a first-generation home buyer. Now, we do have some applicants that where their parents, unfortunately, have passed away. And we're asking, if you do have someone, or if you're someone where your parent has passed away, we're asking, did your parent own a home at the time of death? And if that is a yes, unfortunately, that applicant would not qualify as a first-generation home buyer. And it's the parent. When we talk about parents, we're talking about biological or adoptive parents. Now, if your parent is no longer living and at the time of death, if they did not own a home at the time of death, then yes, the applicant would meet the definition of a first-generation home buyer as long as the applicant has not been named on a title or on a mortgage within the last 7 years. Now, I think this is a great addition to the program requirement that we've added, and that's reaching out to anyone that has been placed in foster care. So if anyone has been placed in foster care and they have valid documentation proving that they've been placed in foster care, we don't even ask any questions about their parents. So as long as they can prove that they were placed in foster care and that child or that adult that was placed in foster care has not owned a home within the last 7 years, they meet that first-generation home buyer requirement. And I know this is a tough requirement, but essentially that's $150,000 that they could potentially get. And we're looking to make sure that the funds are getting into the hands of those individuals that may not had a chance of home ownership. So we're looking at those first generation home buyers to make sure that they get that opportunity to receive a larger down payment to help them obtain home ownership. Now, if you have any questions, please jot all questions down, type them out in the chat box. I'm more than happy to answer any questions surrounding this definition. But keep in mind, only one applicant on the loan must meet the definition of a first generation home buyer. Not all, just only one applicant must meet that first generation home buyer requirement. But we do ask that all borrowers on the loan meet our definition of a first-time home buyer. And remember, our definition of a first-time home buyer is no ownership interest in your primary residence within the last 3 years. I know so we have our first-time home buyer requirement and there's a first-generation home buyer requirement. But please, if you have any questions, I'm more than happy to help answer any scenario questions you may have. But how does this just Dream for All shared appreciation loan program works? I know this is a very unique program. Focus in on that shared appreciation component because essentially you're getting a loan to cover your down payment and or closing costs. So there's a loan that you get. But when you go to sell your home, you're paying back that original loan amount plus a percentage of your home values appreciation. So that's key, okay? So here is an example on our screen here that you see. And basically what this example is showing you is how you would calculate that shared appreciation component that would have to be paid back. So let's say you purchased your home at $500,000. And that was the sales price or the appraised value, but you purchased it at $500,000 and you opted for 20%. You took out 20% to help cover your down payment and or closing costs. So 20% of $500,000 comes out to a $100,000 loan amount. And so that $100,000 was used to cover your down payment and or closing costs. Now the loan is closed and you're in the home. You're enjoying your home. You're living that life of home ownership and you're proud. Years later, you decide to sell your home. Maybe it's 5, 6 years have passed and now you have decided to sell your home because now you want to upgrade or whatever the situation may be. But when you go to sell your home, here on the screen, it says at time of sale, refi or other transfer, at time of sale or transfer, the new value of your home is now $700,000. Remember, you originally purchased it at $500,000 and now the new value of your home is $700,000. If you take 700 subtracted by $500,000, you'll get a $200,000 appreciation. So that's how much your home has appreciated over time. So then you'll take that 20%, because remember, you took 20% of the purchase price to come up with that $100,000. Now you'll always owe the $100,000, but there's a percentage of your home values appreciation you must pay back. So the home appreciated at $200,000. So you're going to take 20% of the $200,000, which equates to $40,000. So in total, when you go to sell your home, you're going to pay back the original loan amount, which is $100,000, plus 20% of your home values appreciation, which equates to $40,000. So those two combined in total, you'll be paying back $140,000 when you sell your home. Now, if you sell your home, refinance, or if you had a transfer of title, that assistance would be due and payable. Now, the Dream for All shared appreciation loan is a loan. It's not a grant and it's not forgivable. So it is a loan, but you don't have to make payments while you're in the loan. You can, if you want to, you can make payments while you're in the loan. But anytime that first mortgage is paid off, or if you sell your home, you have to pay back the assistance on the program. And essentially, the program is there to help individuals receive that larger down payment to cover their down payment and closing costs. So that's how the program works. Very quick example. But I highly encourage you, if you are interested in this program, you must visit our website and take the Dream for All education course. It's a 1-hour online free Dream for All education course. It will further unpack and explain how the program works. It'll give you examples, but it's there to make sure that you fully understand how this program works, because you don't want to sign anything you don't fully understand. We don't require you to take the Dream for All education course prior to the portal opening, but we recommend it. We recommend it, just to make sure you fully understand this program before registering, but it's not required. If you are one of the lucky ones that gets selected for the program, you will have to take the Dream for All education course along with the 8-hour homebuyer education course. So in total, there will be 2 certificates needed if you are one of the lucky ones that are selected for this program. I often get questions about, well, what if home values decline? What happens if we have an unfortunate market and home values decline? What happens then? In that scenario, your home didn't appreciate. So there's no shared appreciation that you'll have to share. You would just still owe the original loan amount that you borrowed. But if the home values declined and your home did not appreciate, you do not have to share in your home's appreciation. And then sometimes I've gotten questions about, well, what if I purchased my home at $500,000 and values shoot up to $2 million. What happens then? Well, CalHFA, we did put a cap on the amount of shared appreciation one will ever have to pay back. And that cap is 2.5 times the original loan amount. And so there is a cap, and it will always be 2.5 times the original loan amount to help prepare for just in case home values skyrocket. But please, again, if you have any questions, please type them out in the chat box and I will be more than happy to answer your questions. So how do you prepare? Remember, I told you that there is a pre-registration portal that you will have to register if you are interested in this program. So if you're interested, the first thing that you need to do is talk to a CalHFA approved lender. That lender is going to determine if you are even eligible for the program. They're going to pull your credit. They're going to ask you questions about what county you are looking to purchase in, because they need to make sure that your income is within those income limits per the county in which you are looking to purchase in. And then they may even ask questions to gauge whether or not you are a first-generation home buyer. Remember, we only need one applicant on the loan to meet the first-generation home buyer requirement. But the first thing you need to do is talk to a CalHFA approved lender. Once they determine if you meet the program requirements, they're going to issue you a specific Dream for All pre-approval letter. You're going to need to keep that letter, because when the portal opens, which is April 3rd at 8 a.m. through April 29th at 5 p.m. That in that time frame, you're going to go and register for the course. We're asking that you take the 1-hour Dream for All education course now so that you fully understand how the program works, but it's not required. We're just asking because we want to make sure you have as much information as possible about the program. So I know the portal opens tomorrow. It's okay. You don't have to be the first person to apply when the portal opens tomorrow. In fact, we recommend waiting a little bit because we don't want the portal to crash. So hold off. It's okay. And I know that we're giving this webinar with not that much time, without that much notice. But while you're waiting for the portal to open, gather these documents. So you're gonna talk to a CalHFA approved lender. They're gonna give you the Dream for All pre-approval letter filled out. You're gonna hang on to that letter, and then you're gonna need to gather a valid current government ID. So when I say government ID, I mean that it's not expired. So if it's expired, go down to DMV to get a current copy. But a government ID that we'll accept is a state driver's license. We'll accept a identification card, a military card. We will even accept a passport or a permanent residence card, or a visa, or an employment authorization. We need something that was issued by the government, and it has to be current, no expired documents. In addition to that, you'll need to provide proof of your current address. That could be a utility bill, current, not a utility bill that was issued a year ago or 6 months ago. It has to be a current utility bill to prove where you currently reside. In addition to that, if you were ever placed in foster care, gather that documentation now. Because remember, if you were ever placed in foster care, you don't have to answer questions about your parents. They're just looking to see valid foster care documentation, and you'll need to make sure that you haven't owned a home within the last 7 years. But gather valid foster care documentation. Anything that was issued by the Department of Social Services or any court-ordered documents will be sufficient at proving that you were placed in foster care. So gather those documents now. And on my screen, it doesn't say this, but I'm telling you, gather a copy of your birth certificate or medical records or school records, just in case when you enter this information in the portal and the system needs additional information, make sure you have a copy of your birth certificate, because that could further help with proving that your parent doesn't currently have ownership interests in a property. Again, as I mentioned, the portal will open April 3rd, 8 a.m. and it will close April 29th at 5 p.m. Now, if you are interested in this program, please do not wait until April 29th to register for the program. You want to make sure you register early on. And you don't have to register on April 3rd either. You just want to make sure you're giving it enough time and you're registering between that window, that time frame. So once you register for the portal, so first thing you're doing is talking to a CalHFA lender, and then you're going to register in the portal. Once you register in the portal, and the portal closes, there will be a robust audit process conducted. And it's going to be conducted by a third-party company. They're going to audit the information that was entered into the portal. After that, there will be a random selection. Now, it's not us selecting it. It's a computerized random selection to determine who will actually receive a voucher. We're hoping that anywhere between mid-May or sometime in June, we'll have an announcement on who actually were the participants that receives the voucher. So once you receive that voucher, you'll have 90 days to shop for a home, enter into a contract, and have a CalHFA approved lender reserve your loan in our MAS system. So it's giving you time to shop for a home. But throughout this whole process, you must continue to meet the program requirements. That's key. Now, remember in the beginning of the presentation, I told you our website. This is what our homepage of our website looks like. Lots of great information here on our website. Again, our web address is calhfa.ca.gov. And here on the screen, you'll see two boxes outlined in red. The box at the bottom, it has a radio button so that you can click on to find an approved CalHFA lender or loan officer. So you must work with someone that's listed on our website if you are interested in any CalHFA program. You have to make sure that they're listed on our website, and you would search for someone by clicking the Find a Loan Officer button. Now, if you have someone, you've located a CalHFA approved lender and they have given you the Dream for All pre-approval letter, you're going to click the box at the top where there's a red arrow. You're going to click the home buyers box. Once you click that home buyers box, it's going to take you to this screen of our website. I highly encourage you all to read through this section of our website. It has a ton of information available to you. It further explains the first generation versus first-time home buyer requirement. It also explains our program. It gives you the definition of a first-time home buyer, lots of resources. It even has the income limits for the Dream for All program listed on this section of the website, because I only showed you a few counties. You may be looking for a county, looking to purchase in a county that wasn't displayed on the screen, but there is a link on this section of the website that will take you to our income limits. And further down on this section will outline the next steps that you must take for this Dream for All shared appreciation loan program. But to the right of this section, you'll see register for a voucher with the red arrow. That's where you're going to go to register for the portal that I mentioned. And you're going to click that when we should be going live tomorrow. And that radio button will be active and available for you to register. But that's how you would register for the program. But please take time to go to our website. At the top of the page, you'll see a gray header where it says program resources. There are much more videos on that section of the website that explains in detail the program and how to prepare for the program. So, as a recap, as we come to the end, I explained to you, we talked about our My Home Assistance program, and I discussed the Dream for All shared appreciation loan program. Lots of information, I know, lots of information, but I like to go over the differences of both programs. They're both designed as down payment assistance, closing cost assistance, loans to help you obtain home ownership. Now, on our My Home Assistance program, it's available just to first-time home buyers. It doesn't have that first-generation component like the Dream for All shared appreciation loan program does. So if you are interested in purchasing a home and you need some assistance, but you don't quite meet the first-generation home buyer requirement, My Home Assistance doesn't have that first generation home buyer requirement, and it's an option there for you to help you obtain home ownership. On the My Home Assistance Program, the funds are always available. Unlike the Dream for All Shared Appreciation Loan Program, at this moment, at this time, we have limited funding on the program, and there will be a random selection. So basically, it's not guaranteed that if you apply or register for the program under the Dream for All Shared Appreciation Loan Program that you will be selected, because remember, it's a random selection on who gets selected for the program. On the My Home Assistance Program, there's no shared appreciation. Unlike Dream for All, remember, you're going to share in your home values appreciation. On My Home, you're just paying back the original loan amount plus any accrued interest. And as I mentioned, My Home has a 1% simple interest rate. So if you borrowed $20,000, each year $200 is added to the original loan balance. Now, Dream for All offers a larger down payment, but there's that shared appreciation component that you have to keep in mind of. My Home Assistance has higher income limits. Dream for All has slightly reduced income limits, and it's specific to that program. Now, on the My Home Assistance Program, a home buyer can add additional funds to go towards the down payment to help further reduce their monthly obligation if they wanted to. It's not required. On Dream for All, we capped the amount of borrower-owned funds that they can use to contribute to the down payment, and we capped it at 5%. But those are the differences between My Home Assistance versus Dream for All. They're both great programs. It just depends on your need and what best fits you. So it's really crucial that you do your research, understand these programs, understand how they work. But they're programs designed to help you get into that home so that you can be a homeowner, because that's what we're here for. We want to increase home ownership throughout the state of California. But thank you. Thank you so much for having me. Here is my contact information, and I'd love to open it up to Q&As to see if you have any questions.
All right. That was a great presentation. And if you all have questions, please put them in the chat. I already have some that have come to me. So Tasha, I'll start with the first program, My Home Assistance Program.
Yes.
So the first question, and this is from Melody Downing, and is there a limit